So we have a lot to talk about. The stock market's been pretty much straight up for 2024. 2025 is around the corner, and everybody's asking me, what do you think is going to happen in the stock market in 2025? Are we going to crash? Are we going to keep going up? What is happening right now? So looking at my account right here, this is one of the things that makes me actually a little bit concerned. Look at my year-to-date return right here. I am up 85% year-to-date. That is not typical. Of course, I'm not complaining I'm up $432,000 in 1 year. But that is not typical for the stock market. If we go to a 2-year return right here, 218%, $644,000. Absolutely crushing it. And this is what happens when you do stocks and stock options the right way. So we're going to head over to my Alpha report. It's 100% free. If you want to get it, the link is below for that. So we're going to break down in this Alpha report what I see going on for the stock market for 2025 and a couple examples of why I think the stock market's going to actually do that. So my account did briefly touch $1 million. Then the stock market took a little bit of a dip after Jerome Powell lowered interest rates. But the reason why it went down is because there's less interest rate cuts expected to happen for 2025. So the market did go down a little bit, but that's totally fine. I feel like we needed to get a dip, and the stock market's pretty much been going straight up. It's kind of like getting disconnected from the fundamentals a little bit. We're going to go into that in just a second, and then how you should play 2025. So you really want to stick around till the end of this video. I promise you it's going to help you out a lot. But this little dip right here, this was what just happened from Jerome Powell, and it's justified. So heading over to the Fear Greed Index, we're roughly 28 right now, so we are in the fear category. And I do feel like this Fear Greed Index is actually being a little bit too conservative. I feel like we're closer to 55 on the scale, so we are slightly greedy in my opinion. I said right here, a little 5% dip is not a big needle mover. It's not like everything right now is automatically on sale. And a lot of things that I talk about with people on Twitter or YouTube or really in my Discord too is, oh, the stock market fell 5%. I want to buy that dip. But it's like, dude, what if the stock market's 20% overvalued and now you just bought it 15% overvalued? So just because it went down 5%, that doesn't mean you're necessarily getting a good deal. So heading down to the economic updates, so the market did go down when Jerome Powell cut interest rates, but now the market went back up on Friday because the inflation data came in a little bit softer. And you guys know I'm like a broken record, and I really want to pound this into your head a few more times. Interest rates are like gravity on the stock market. So when Jerome Powell guided for 2025 that we're probably only going to get 2, maybe 3 interest rate cuts, the market went down on that news because the market was expecting 4, and some people even said 5 interest rate cuts. So it's like if the stock market's expected to get roughly 10% per year and you could get 4 or 5% in a bond, there is a little bit of competition. People are going to debate, do I go in the stock market when maybe it's a little bit overvalued and get that risky 10%? Or do I go into a bond and get the guaranteed 4.5%, just say? So for next year, we were expecting yields to go down by roughly 1.5%. They're roughly 4.5% right now. If they would have went from 4.5% to 3%, that is a needle mover. That's a 3% bond versus 10% in the stock market. That spread between the two is wider. So there's not many people that are going to say, I want to go put my money in a bond instead of the stock market. But now that rates are expected to stay a little bit higher, which is actually a good sign that most people don't really understand, is rates have to be higher because inflation is a little bit sticky, somewhere around like the 2.3% level, 2.5% level, because the economy is strong. Inflation is kind of like a supply and demand function right there. So there's demand in the economy. That's why these companies have pricing power and they're able to raise their prices because people are willing to pay the prices. If there wasn't demand in the economy, the companies would then have to go lower their prices on things. So I feel like we are on a path to 2%. We went from roughly 9% 2 years ago to now we're around 2.3%. So we are very close to our inflation target. We're not quite there yet. So I don't really want to elaborate more on that and bore you, but interest rates are very, very important. So the stock market did take a dip. There's stocks like Tesla, Palantir, SoFi, Celsius. A lot of those stocks did take a pretty big hit. Tesla, like I've been talking about in my last video, I think it was 2 videos ago, it pretty much has been going straight up. It's disconnected from the fundamentals. So the blow off top kind of happened. Now Tesla's down like 60, 70 bucks per share. Totally fine. I told my wife that I'm really never going to sell my Tesla shares until I come home and there's an Optimus robot sitting on my couch, cooking me dinner, doing stuff around the house for me. I know it sounds crazy, but I am not going to sell my shares until that happens. Or if Tesla happens like absolutely moon or something and it's totally like out of control disconnected, I might sell and then maybe try to buy it lower. but I don't want to realize the taxes on it, so I probably won't do it. But here's the thing. What do I see like is going on in the market for 2025, and how can you personally play this? So this is one of the most important things right here that I talk about in my course. It's one of the ways that you could easily value a stock or the stock market. So this right here is the chart of the S&P 500. This is VOO. So VOO is one of my favorite ways to get exposure to the S&P 500. Super cheap. It's an ETF. It trades all day long. A lot of liquidity. It's great. So this chart goes from 2020 to current. So this solid line right here, this solid line corresponds to what the earnings growth of the companies within the S&P 500 have done. And then I also broke that down right here. So 2020 through 2024. So in the stock market, the number one thing that matters at the end of the day, after everything is all said and done, the number one thing, it's not the Fibonacci, it's not the simple moving average, it's not the VWAP, it's not the Bollinger, it's not any of that stuff. The number one thing that matters is what the earnings of the companies do. If the earnings go down, the stock is probably going to go down. If the earnings go up, the stock is probably going to go up. So that is the name of the game. You have to understand for right now and for next year and years going forward, this video is not only about 2025, this is about making a crap ton of money in the years going ahead. So for 2025, do we expect earnings to go up, down, or stay flat? I personally expect earnings to go up, but are they going to go up enough to justify the valuation of the stock market right now? So let's dive into here a little bit. So these are the years right here, and the numbers next to it right here in percentages. This is the earnings growth of the companies in the S&P 500. So 2020, this was just after COVID. We had a 32% decline in earnings of the companies. Of course, that's expected. We have COVID, we had shutdowns, all that stuff. But in 2021, we had a rapid rebound where the earnings went up 110%. Of course, it's kind of like magnified off of this low rate here, so it's really not as much as it seems because it was just coming off of a low number. So when you add up all these 5 percentages right here, that number right here will come out to 91% total. Just add them up. That's a 91% earnings growth in the last 5 years. So just to keep things simple, not to compound it or anything like that, it's just a simple 91% earnings growth in the last 5 years. Now, before I go into the kicker, and you might have looked below and saw it, but guess what? The stock market actually went up in that same time frame too. So the earnings, this line right here is a 91% gain right here. But the stock right here, from here to here, you notice that the line is connected right here, and the line is connected right here for the earnings growth and what the actual VOO index did, which, like I said, is the S&P 500. They matched. You could do the math for yourself. The S&P 500 went up 91% in the last 5 years also. So I keep saying, like, earnings are the literal number one thing that matters, and it's actually really funny that it came out to the exact same number. I didn't try to rig this data or anything or pick the dates or whatever. That's just literally I plugged in the numbers and that's what it actually came out to be. So you could look at this chart right here and you can make some conclusions. So this was COVID right here, the pandemic, when the market took a dip. So this is the mean line of earnings. So when the stock market took a dip below the mean line of earnings right here, the market appeared to be undervalued. So if you would have bought in this category right here, boom, it looks pretty obvious that the stock market should have rebounded back to the mean line. And what I tell people right now is stocks try to follow the mean line in the long run, but in the short term, stocks do not follow the mean line. So this is how there's usually always opportunities in the stock market, whether something is overvalued or undervalued, and then you make a play based on the valuation level. So right here, things appear to be undervalued. So then the stock market made a pretty rapid run right here, and then the stock market started to get a little bit stretched and went above the mean line of growth right here. So anything above the mean line right here, I consider to be a little bit overvalued. So if you would have just looked at the chart and said, okay, we're a little bit above the growth line right here, right through this whole period right here, you could see that the market is overvalued by a little bit. And then look what happened. The market took a dip through 2022. Now, a lot of the reason why the market took a dip through 2022 is because we had inflation, and like we talked about earlier, interest rates are like gravity on the stock market. So this period right here is where Jerome Powell started raising interest rates. As rates went up, the stock market valuations went down, so the market took a little bit of a correction. But right here, and this is going to lead into 2025 and going into the future because we're going to go into the current here in just a second. But right here on this dip, you could see how far below the mean line right here that the actual S&P 500 index was. We were pretty cheap right here. And I talked about right here, as you guys know, in 2022, I was aggressively positioning myself to capitalize on the next bull run. Everybody was freaking out to sell. I was freaking out to buy. I still had a day job in this period right here. And everybody at work was like, dude, the stock market's crashing. It's the next 2008. It's going to go down 30% more. It's the next 1999, Texas bubble, blah, 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 all this crazy stuff. So everybody was freaking out to sell. I was freaking out to buy. I was buying call options. I was selling put options. I was putting all the money I had on the sidelines into the stock market. And my net worth around this time period right here was roughly like $700,000. So from right here to where we're at currently, this move that I capitalized on and positioned myself to hit on really good in 2022, I made over $2 million from 2022 to current. I'm not kidding around. My net worth went from roughly $500K to roughly $2.5 million in this time period right here. We've been on a crazy bull run, but this is the power of capitalizing on the stock market when there's a lot of opportunities. So right now, 2025, what do I see going forward? So right now, I do feel like we're trading near intrinsic value, but I do feel like we're a little bit on the lofty side, which means like a little bit on the expensive side. So what am I personally doing right now to capitalize on 2025 and years going forward? So let's look at this chart right here. Let's just pretend that right now we're right here. So right now, it's connected right here and it's connected right here. So it appears to be trading at intrinsic value. There is a chance that the market could go down 20% from where we're at right now, or maybe we're right here and we're connected and the market can go up even higher. So hopefully that made sense for you. Like, I'm basically saying the market could either go up or down. And I know that's probably not the answer that you want to hear, but it's like nobody definitively knows what the market's going to do for 2025. Is the market a little bit lofty right now? Yes. But are these companies actually producing a crap ton of profits? Yes. Are the profits expected to go higher? Yes. It's just a question of, are they actually going to go higher? Because almost like perfection is priced into the market right now. So if the expectations are met, we could have another really good year for 2025. But if the expectations are not met, the market could take a dip. It could look like we're right here right now. Maybe Triple Q is going to go down by 35%, which is what happened on this dip right here. I honestly doubt it. If I had a gun to my head and had to tell you guys what I really think the market's going to do next year, I think there's going to be a lot of volatility, but I would expect maybe a 5 to 10% return for the 1 year going ahead in the market. Nobody on earth knows. I could be 100% wrong, but this year we had a 25 to 30% return on the NASDAQ and the S&P 500. I am not expecting that for next year. I think that a lot of that stuff is already priced into the market right now. So maybe we go down 20%, then we go up 30%, so we end the year 10% higher, but that's okay. And if you're not okay with that volatility in the market, you probably shouldn't be in the market anyways. I buy shares of VOO, Triple Q, and some individual companies, and that is the base of my portfolio, and I plan to hold on to that forever. But when I see opportunities in a market like right here, I then will go sell puts and buy calls to position my portfolio to capitalize on the years to come because I'm buying at a discount at that time right there. Now, right now, I'm still generating roughly $30,000 a month in the market right now, but there's not as many opportunities out there as there was in this time period right here. So I'm being very careful. I am prepared for a 20 to 30% drop if it were to come, but if it doesn't come, that's fine. I'm still positioned to capitalize on the upside, but if there is a bunch of downside, I have a lot of buying power in my trading accounts ready to go in order to capitalize. So that's what I see going forward for the market in 2025. If you want to learn how I trade stocks and stock options, 100% strongly recommend that you do my course below. It's on sale. It's helped hundreds of people. Hundreds of people are already scaling their portfolios, making thousands of dollars a month with stock options. Check the link below for that. But if you don't want to do my course, I made a video right here for you guys. It's a very basic level of stock options and how I do it. So I'll see you guys there.